Let me ask you a question. Are you actually insured or you're just paying insurance? All right, guys, welcome back to another edition of Capital Claims Group TV. Today, we want to take time out to talk about a very, very important topic. If you own multiple rental properties, I'm talking 10 doors, 20 doors, even 50 doors. Let me ask you a question. Are you actually insured or you're just paying insurance? Because there's a dangerous trend going on right now across the country, especially in my home state of Florida, where property owners or people who own these portfolios and tons of different investment properties are just buying what they call cheap insurance to satisfy the mortgage. Investors are chasing cheap premiums and buying bare bone policies, assuming that they're protected if something catastrophic happens. Until the day they have to file a claim, then they realize they didn't buy protection, they just bought financial illusion. So let's talk about number one, the false economy of cheap insurance. While you may think cheap insurance is the most economic, but that could put you at the most risk. When you start reducing insurance to a line item expense, then you start saying things like, how can I get this cost lower? But the reality is insurance is not expensive, it's risk transfer capital. When you underinsure your properties, you're not saving money, you're retaining a risk that you really just don't understand. You may save $5,000, $10,000, even $15,000 across your whole portfolio. But this exposes you to partial denials, roof schedules, coverage exclusions, depreciation traps, cosmetic damage limitations, and that underfunded liability is sitting there in your balance sheet. So let's walk in and talk about your portfolio blind spots. When you start scaling to multiple properties, you stop reviewing all the policies individually, and you start thinking that if one is good, then they all are good. And that in itself is a huge mistake. What we see every day, different carriers, different forms, different endorsements, different exclusions, all in the same portfolio. One building is covered with replacement costs, the other one is ACV. One building has a 5% deductible, one has a wind exclusion, and the investor has no idea. So when a loss hits or a huge wind event happens, you don't have just one problem. Now you have 15 different outcomes that can happen from these 15 different policies that are written 15 different ways. So let's talk about what I call the patchwork trap. I've seen a ton of properties where they just do the patchwork just enough to maintain it, enough to get a tenant in there. But it's not enough to protect the structure for its long term or for the long term. So what happens? People start patching the roof, spot repair water leaks, delay even getting a full replacement, not doing the work properly, especially with water leaks, can cause mold and cause other things to start happening on after that. You may be expecting the insurance company to step in when there's a huge or a major catastrophic event, but here is where the problem may lie, because the insurance company has no intention to upgrade your property, and they'll be more than happy to tell you our job is not to upgrade your property. If you leave it run down when something happens, they're going to try to go back and leave it run down. So if your roof is already run down or worn, or you have other issues going on that makes the documentation weak, this is where the carrier comes in and you give them multiple pathways of reducing your claim, or worse, denying it. And we go into our next part, the $1 million misunderstanding. And this is where most investors get caught off guard. They believe I have insurance, I should be protected across my whole policy or my whole portfolio. But protection is not just having a policy. It's the policy language, the coverage structure, the deductible strategy, documentation. All right, let's look at let me try to give you a real life strategy or a real life scenario, right? Let's say you're paying about $200,000 in insurance across your portfolio, but your policy is structured incorrectly. You're not protecting your assets. You're donating about $200,000 a year to the carrier, because when the claim comes in, then the policy will begin to be audited in real time. So we have the carrier advantage versus the owner's exposure. Don't forget, I told you in the other video, the carriers are very, very sophisticated. They have their engineers, they have their attorneys, they have their underwriting. So these policies are written in a certain way with a ton of added legal terms that you got to comprehend in real time. And they operate in what I like to call the four corners of the policy. Actual cash value, that's what you get. If the policy says cosmetic damage is excluded, that's what they enforce. If the policy says matching limitations, that's how they scope it. And the policy is a contractual document. It's not personal. So what do you have? What you get, what they enforce, how they scope it, and it's not personal. So what should a very super serious property investor be doing? You need to start thinking like a institutional investor. Review every policy annually, standardizing coverages across your portfolio, understanding replacement costs versus actual cost value, evaluating deductibles in relation to the value of the asset, proactively documenting the property conditions, identify exclusions before a loss happens. And most importantly, bring in professionals who understand claims before you have one, not after. Here's the truth that most people don't want to hear. You don't really find out how good your insurance policy is until you really need it. And then it's already too late to fix it. So if you're a property owner, landlord, or managing a large portfolio, ask yourself, are you building wealth or are you slowly exposing it? Because cheap insurance doesn't protect your portfolio. Strategic insurance does. So if you are a property owner, investor, somebody dealing with multiple properties at a time and you haven't had a full policy review, that should be your next move. Because in this business, the difference between a protected portfolio and a vulnerable one, it's not the deal you made, but it's the coverage that you chose. That's it. I gotta go. Thank you for watching CCG TV. Reach out to me, Capital Claims Group, if you have policies that you don't understand, or you need somebody to review these policies and give you some insight on what your coverages really look like. Reach out to Capital Claims Group. Thank you again. Like, subscribe, follow the channel.
Depreciate.